In the summer of 2017, European banking regulators achieved something that had never been done before. They executed the continent's first ever bank resolution under new post-financial crisis rules, completely wiping out shareholders of Spain's sixth largest bank and selling the entire institution for the symbolic price of €1. The target was Banco Popular, a 91-year-old Spanish banking giant with over €300 billion in assets, 2.8 million customers, and 15,000 employees. In less than 72 hours, this institution went from being a struggling but operational bank to being completely absorbed by its larger rival Banco Santander for less than the price of a cup of coffee. The speed and brutality of the resolution sent shockwaves through Europe's banking sector and marked a pivotal moment in how regulators would handle failing banks in the post-2008 world. Banco Popular's story began in 1926 when it was founded as Banco Popular Español by a group of Spanish businessmen who wanted to create a bank focused on serving small and medium-sized enterprises. The bank grew steadily through Spain's turbulent 20th century, surviving the Spanish Civil War, World War II, and Francisco Franco's dictatorship. During Spain's economic transformation in the 1960s and 1970s, Popular expanded rapidly, opening branches across the country and building a reputation as a reliable lender to Spanish businesses. The bank went public in 1974 and by the 1980s had established itself as one of Spain's most important financial institutions. Popular's business model was straightforward but effective. It focused on traditional commercial banking, avoiding the complex investment banking activities that would later cause problems for many of its competitors. The bank's conservative approach served it well through various economic cycles, and by the early 2000s, Banco Popular was widely regarded as one of Europe's most solid regional banks. The first cracks in Popular's foundation appeared during Spain's spectacular real estate boom in the mid-2000s. Like virtually every Spanish bank, Popular became heavily involved in financing the country's property bubble, which saw real estate prices triple between 1997 and 2007. The bank aggressively expanded its real estate lending portfolio, financing everything from residential developments to massive commercial projects across Spain. Popular's loan book became increasingly concentrated in construction and real estate development, sectors that Spanish banks had traditionally viewed as virtually risk-free given the country's rapidly rising property values. The bank also expanded into Portugal during this period, acquiring several smaller Portuguese banks and further increasing its exposure to Iberian real estate markets. By 2007, real estate-related loans accounted for nearly 60% of Popular's total loan portfolio, making it one of Spain's most exposed banks when the property bubble finally burst. When Spain's real estate market collapsed in 2008, Banco Popular found itself facing a crisis of unprecedented proportions. The bank's carefully constructed loan portfolio, built over decades of conservative banking, was suddenly filled with non-performing loans to bankrupt developers and homeowners facing negative equity. Popular's non-performing loan ratio skyrocketed from less than 1% in 2007 to over 13% by 2012, representing billions of euros in potential losses. The bank was forced to make massive provisions for loan losses, wiping out profits and eating into capital reserves. Unlike some of its competitors, Popular managed to avoid requesting direct government assistance during the initial phase of Spain's banking crisis, instead relying on private capital raises and asset sales to maintain solvency. However, the bank's problems proved more persistent than initially anticipated as Spain's economic recession dragged on and real estate values continued to fall. Throughout the early 2010s, Popular embarked on an increasingly desperate series of restructuring efforts designed to restore profitability and confidence. The bank conducted multiple capital raises, selling new shares to existing investors and bringing in fresh capital from international funds. Popular also launched aggressive cost-cutting programs, closing hundreds of branches and laying off thousands of employees in an effort to reduce expenses. The bank sold off non-core assets, including its Portuguese operations and various subsidiaries, generating cash to strengthen its balance sheet. Despite these efforts, Popular continued to struggle with weak profitability and persistent asset quality problems. The bank's stock price, which had traded above €15 per share before the crisis, fell below €2 by 2016 and continued declining as investors lost confidence in management's ability to turn the situation around. The beginning of the end for Banco Popular came in early 2017, when European banking regulators began expressing serious concerns about the bank's capital adequacy and business model. The European Central Bank, which had assumed supervisory responsibility for Europe's largest banks, conducted a comprehensive review of Popular's finances and concluded that the bank faced severe capital shortfalls. Popular's management attempted one final capital raise in May 2017, seeking to raise 2.5 billion euros from investors to strengthen the bank's balance sheet and satisfy regulatory requirements. However, this effort proved to be the fatal blow. The capital raise failed spectacularly when investors showed little interest in subscribing to new shares. On June 6, 2017, Popular announced that its rights offering had been severely undersubscribed, raising only a fraction of the intended amount. This failure triggered immediate concerns about the bank's viability and sparked a devastating run on deposits. The final 72 hours of Banco Popular's independent existence unfolded with breathtaking speed and unprecedented regulatory coordination. On June 6, immediately following the failed capital raise announcement, Popular began experiencing massive deposit outflows as customers rushed to withdraw their money. The bank lost over 8 billion euros in deposits in just 2 days, representing nearly 20% of its total deposit base. Spanish regulators worked frantically with their European counterparts to prevent a complete collapse that could have triggered broader financial instability. On June 7th, the European Central Bank officially determined that Popular was failing or likely to fail, triggering the European Union's new bank resolution mechanism for the first time. The Single Resolution Board, a new European regulatory body created after the 2008 financial crisis, was given authority to handle Popular's resolution and immediately began working to find a buyer for the failing bank. The resolution of Banco Popular represented a watershed moment in European banking regulation and demonstrated how dramatically the rules had changed since the 2008 financial crisis. Under the EU's new Bank Recovery and Resolution Directive, regulators possessed unprecedented powers to impose losses on bank shareholders and creditors before using any taxpayer money to support failing institutions. The Single Resolution Board used these powers to completely wipe out Popular's shareholders, canceling all existing shares and eliminating approximately 2 billion euros in shareholder equity. The board also imposed losses on holders of Popular's subordinated debt, including contingent convertible bonds that were designed to absorb losses in exactly this type of scenario. These bail-in provisions meant that private investors, rather than taxpayers, would bear the cost of Popular's failure, a dramatic departure from the bank bailouts that had characterized the 2008 crisis. Finding a buyer for Popular proved surprisingly straightforward, as Banco Santander quickly emerged as the only viable candidate willing to take on the failed bank. Santander, Spain's largest bank and one of Europe's most successful financial institutions, had the capital and operational capacity to absorb Popular's operations while managing the associated risks. The resolution took place over a single weekend, with regulators working around the clock to complete the transaction before markets reopened on Monday. Santander agreed to purchase the resolved bank for €1, but also committed to injecting approximately 7 billion euros in fresh capital to strengthen Popular's balance sheet and ensure business continuity. The deal included all of Popular's branches, employees, and customer relationships, essentially making the acquisition a rescue takeover rather than a liquidation. For Santander, the acquisition represented an opportunity to significantly expand its Spanish market presence and acquire valuable customer relationships at an attractive price. The aftermath of Popular's resolution sent shockwaves through European financial markets and fundamentally changed how investors viewed banking risks in the post-crisis era. Popular's shareholders, who included many Spanish retail investors and pension funds, lost their entire investment overnight with no compensation or recovery prospects. The bank's contingent convertible bondholders, who had believed their investments were relatively safe, discovered that these instruments could indeed result in total losses as designed. Credit ratings agencies immediately began reviewing their assessments of other European banks, particularly those with similar risk profiles to Popular. The resolution demonstrated that European regulators now possessed both the tools and the willingness to impose harsh consequences on failing banks without resorting to taxpayer bailouts. This new reality forced investors to conduct more rigorous analysis of bank credit risks and led to significant repricing of bank securities across Europe. The successful resolution of Banco Popular, while traumatic for its shareholders and some creditors, ultimately validated the European Union's new approach to handling bank failures and demonstrated that large financial institutions could be wound down without triggering systemic crises. The bank's 15,000 employees kept their jobs under Santander's ownership, and customer deposits remained fully protected throughout the process. Popular's 300 billion euros in assets were successfully transferred to Santander without disrupting Spain's broader financial system or requiring government intervention. The resolution proved that the too-big-to-fail problem that had plagued regulators during the 2008 crisis could be addressed through properly designed resolution mechanisms. However, the Popular case also highlighted the continuing challenges facing European banks in low-interest rate environments and the ongoing legacy issues from the previous decade's real estate bubble. The bank's rapid collapse demonstrated how quickly confidence could evaporate in the modern banking system and how important strong capital buffers and diversified business models had become for survival. For European banking regulation, Popular's resolution marked both an ending and a beginning. The end of the era when bank failures automatically meant taxpayer bailouts, and the beginning of a new regime where private investors would bear the consequences of poor banking decisions.